In June, our funds generally acted very well. We benefited on the positive side from great performance from a number of our stocks which have a significant US exposure. Companies such as SGS in Switzerland, Beek, Legrand, and Acer Abloy. We were, however, to some extent hurt by a number of our financial positions, which, as you can imagine, acted quite badly with growing fears of a possible Greek default. But overall, we had a good month. It's been an incredible roller coaster over the last few months since we've spoken. Markets clearly have been unsettled by the various problems in the Eurozone area, and of course by questions of a possible growth and slowdown in China. We think in the short term the problems in Europe have been contained by the bailout, and we think anxiety in the wider European bond markets has eased somewhat recently with the introduction of what have really been surprisingly deep and rapid austerity plans. But clearly it's a concern going forward. There may well be some impact on growth, although we see a very strong distinction between the north and the southern parts of Europe. The north should be able to emerge more easily than the south, but of course can't escape the even tougher austerity packages because they're locked within the Eurozone. This, though, we think could be more than offset by the weakness in the euro, which has had a very strong stimulatory effect on the economy. So there are clearly some perhaps greater negatives than what we've spoken over the past few months arising out of the possible Greek default. But on the positive side, and continues to look better and better, is the strength of the corporate sector. And we think earnings will continue for some time yet to significantly exceed expectations. And there are three main drivers for this. First of all, we saw the dramatic cost-cutting plans which were introduced post the Lehman crisis, and they've been much deeper and more rapidly introduced than we might have expected. We've also seen that demand has continued to be very resilient and strong from the emerging world, and we see the recovery in the West beginning to really accelerate. And most of our company meetings, companies we've met with in the last few weeks and months, have attested to really accelerating recovery right across the Eurozone. We're also seeing, for most of our companies, access to credit becoming much easier. Certainly the larger companies are being able to really very easily raise significant amounts of bond debt and bank debt. And also this seems to be spreading to smaller and mid-sized companies as well. Valuations, as we've highlighted many times before, stocks have never looked so cheap on 10 times earnings. And against bonds and cash, of course, it breaks all records. We've never seen such low valuations. And just to remind you, again, valuations in Europe, companies still traded at a significant discount to their American counterparts, almost 40% now. And of course, in most cases, in many cases, European companies are just as, if not more profitable than their American counterparts. And maybe lastly, on the positive side, aversion to equities remains as high as I've ever seen it in the 20 years of doing this job. We were in Texas seeing some clients last week, and most still have 80% of their private assets in cash and gold. And also talking to the insurance companies, their exposure now is in many cases sub 1%, which is as low as it has been pretty much since records have been kept. So some anxiety over the Greek default. We kept 100% invested throughout, and markets are now back up to where they were before markets had their wobble. We believe the positives on the corporate side still way more powerful than the possible negatives arising from a Greek default. Finally, as to the shape of our funds, we've progressively sold a number of our deep cyclical, more leveraged investments that we had made in the beginning of 2009, companies that whose share prices were, we thought, way over beaten down in the bear market. And we bought those opportunistically in the beginning of 2009, and we feel now the value premium for quality has fallen to such an extent that we want to get back into which we feel more comfortable with, our favourite, more quality long-term growth situation. So a subtle shift in the shape of the funds over the last few months to really now greater emphasis on quality growth again.